silver bullets form and how did they form and why is it there? They're always going to be there because of the first 30 minutes of price delivery. You have 30 minutes now in the marketplace. The rush, the mad dash to get in there and do something, to buy and sell, that's already in the marketplace now. The initial surge of institutional orders being thrown out there for their clients or their own, that's in the market now too. So now we have 30 minutes behind us. The initial impulsiveness that usually comes into the marketplace is now behind us, and now we're in the first full hour of trading after the bell. The first 30 minutes is done. That's like the Asian range, okay? Now we have the real move, London. Think about it in the 24-hour cycle. Kind of, I'm probably confusing some of you, but the long-term students know what I'm talking about. I'm looking at that range of the intraday movement on the morning session as the same impulsiveness that comes into London, where there's a lot of volume that comes in Forex. That same thing occurs in that first full hour of 10 to 11. They all want to make a mad dash to find profitability. And a lot of the algorithms wait for that first impulsiveness to run higher or lower, and that inefficiency that you find on the time frames and the models I'm showing you, they all dogpile on it. They all dogpile in on that one there. So it's not a measure of the selling or buying pressure that's pushing it. It's the algorithm itself is offering it to them. It's going to move from that fair value gap to wherever it's going to go, regardless of how many people buy or sell into that gap. It doesn't make a difference. Everything in price is scripted. It's completely manipulated. It's absolutely controlled. And the only thing you're trying to do is look for that small little inefficiency when you know where you're aiming for. You're aiming for some higher time frame target, like we outlined for Eurodollar and the dollar index. If you have a higher time frame bias, and we know that that's a directional bias that's looking for a reason to go higher, it would make sense for us to expect some kind of run higher from 9:30 going into 10 o'clock, and looking backwards and seeing in that price run higher, was there any inefficiency or fair value gap? If there is, then we can use that as an entry that has to happen at 10 o'clock to 11 o'clock. The fair value gap doesn't have to form in itself inside of that 1 hour period. It can refer back to some fair value gap that formed, in the run up, if it's bullish, between 9:30 and 10 o'clock. And if you're bearish and you're expecting it to move lower, the fair value gap could form in the move from 9:30's opening down to 10 o'clock's low. So that price leg, wherever the fair value gap would reside there, it can return up into that.